All right, everyone. There looks like there's a smaller group today, but how's everybody doing? Can everybody hear me? Cool, cool. Well, thanks for joining us again on another Wednesday night to talk about underwriting. I know it's not one of the most rah-rah topics that gets everyone all fired up, but I appreciate you guys for being here. And I hope that you guys can walk away from today's session with some value. So for those of you that don't know me, my name is Victor. Let me see. Myself, Trevor, and Marcel, we're the core members of the Multifamily Freedom Chasers, or the Freedom Boys, which which we're now known as. So I'm a pharmacist by training and work at W2 in the pharmaceutical industry as a drug safety scientist. Like Marcel and Trevor, I'm also married and also have 2 kids. So if this is the first time that you guys are joining one of my underwriting Zooms, I put a 1 in the chat just wanted to say welcome to you guys. And a shameless plug, if you haven't already, please plug into our ecosystem. You can join our Multifamily Freedom Chasers Facebook group. You can follow us on Instagram, like and subscribe on our YouTube. We had a 3-part series on how to get started in multifamily underwriting a few months back. And the last session on underwriting the market 101 is also uploaded on our YouTube, along with the recordings of all of our other Zooms as well. If this isn't your first time, thank you for coming back and for maintaining that student mindset. I'll say this every time. That's a mindset that we should all adopt, which is to become a student and to remain a student. The world is always changing, so we must always be learning. And then as we remain students, become a contributor. Take the things that we just learned and contribute back to the community. Help those that need help with the information that you've just learned. And as a result of being a contributor, naturally, you will become a leader. And you see that in our family, in our Freedom Chasers ecosystem and our community leaders. Peter St. Martin, Eddie Charger, Ed, and the Miles family, Jerry and Cheryl, Shelly. We get you activated on Sunday nights with our activation Zoom to get you pumped up and jumpstart your week. Then we have broker talks on Mondays to help you find deals. Then we have napkin underwriting on Tuesdays for after you get your deals from the broker, so you know how to analyze it quickly and efficiently to see if it's a deal or no deal. And then financing and debt market on Wednesdays to help you get loan terms to finance those deals. Just remember, the greatest leader isn't always the one that goes on to do the greatest things. They're the ones that get people to do the greatest things. So we want everyone here to become contributors and leaders so that collectively everyone together can do bigger and greater things than we could ever do on our own. So it's our vision to be able to help activate and propel 100,000 working professionals into their multifamily real estate journey in active and passive investing so that they can acquire that financial freedom to be able to spend time on what brings them purpose, meaning, and joy. All right. So as you would expect from a Freedom Chaser Zoom, because we all came from the corporate world, here's our agenda and what we're going to do today. So we're going to keep this to an hour and an hour only. We'll go over some quick housekeeping, then go into the content for today. And then it wouldn't be a Victor Zoom if we didn't leave you with some homework, right? So there's got to be some actionable items for you to take away with, and then finally we'll close it out with Q&A. So some housekeeping. We're a collaborative community. Everyone, if you want to put your contact information into your name and your target markets in your display name, and in the chat so that we can all network. Unfortunately, we're going to have to keep you guys all muted because there have been unfortunate instances where people are doing inappropriate things. But if you raise your hand, we can unmute you. Turn on your camera if you can. We love to see all your faces, and everyone else would like to see your faces as well. And just be mindful of each other and be active in the chats, asking questions and answering too if you guys know the answer. All right, so about that. So the content for today, we'll call that Underwriting the Market 201. So first, we'll identify some of the KPIs of a market. Then we'll go into employment types and how that fits together with the real estate demand model. So what are the KPIs, the key performance indicators that we're looking at in the market? So I briefly introduced them last week. So I like to look at these KPIs in different categories, which is past performance, present performance, and future performance. So past performance, you have your employment trends. So how did your market's employment and unemployment compare with how the country did on the national level? And you can look at this over any period of time. And alongside that, you want to look at employment diversification. So what are the strong employment sectors in that market? Does it have a diverse set of employment sectors, or is it a one-trick pony? What are the strong employment sectors? You also have a competitive advantage where you can do a shift share analysis. That's where you can compare a specific regional industry in your market and see if how it compared nationally over any period of time. And then present performance. You have demand and supply. Well, what is the current demand for units based on population metrics? And what is the supply of units in that market to see if there is a gap or oversupply? If you know the current population, the rent to own ratio, the number of people per household, you can find out the demand of rental units. And then you can find out the total number of units available in the market from supply side data like CoStar. And then you can determine whether the market needs more units or has too many units. So, everyone says supply and demand. I think it's almost backward thinking. Supply doesn't drive demand. Demand drives supply. So I think of it as demand and supply. Then you have the market cycle. So what quadrant of the market cycle is your market in? Is it in recovery, expansion, hypersupply, or recession? And this is driven by the demand and supply as well. And then future KPIs. So what is your so this is like your crystal ball in predicting future population growth. And you do this through an economic base analysis, through calculating the current economic base and figuring out what is the economic base multiplier and the population employment ratio in that market. So if you found out there are X number of basic jobs coming into the market, you can figure out what the future population and the future rental demand is going to be and see how those new jobs will affect that supply of units in the market. So remember those questions you should know the answer to if you're an active investor, or you should ask the sponsors if you're passive investors. So these questions can be answered by identifying these KPIs in the market. So because everything starts with jobs, let's just review again really quickly the types of jobs that affect population growth and future population and future demand. So what are the different employment types? So first you have basic employment. So again, basic employment, that's your export sector jobs. So these are goods and services are sold outside of the local economy, and then the money is spent inside the economy with some leakage. So what do I mean by that? So again, take back that Volkswagen car manufacturing plant as an example. So the Volkswagen plant is an export sector employer. So they sell cars all over the world after they manufacture them. And then Germany pays the employees inside that plant. And then they go back into the local marketplace and spend that money. So here's how it kind of looks. So let's say that water is money. So here we have money entering the economy, and the bucket is the economy. So the water in the bucket is the money circulating inside the economy. So basic jobs or export sector jobs, that's the faucet. So the faucet is flowing money. So these export sector jobs are bringing in money into the local market, which then fills the bucket up. But then the money isn't always spent in the local market. People like to travel and go on vacations, go to the beach, go to the mountains. Maybe they go outside the economy to buy something. So there's always leakage in the local market. So there's always going to be a tiny little outflow of money. So you need dollars. You need more dollars coming into the market than it is leaving the market. If more is coming in than leaving, then that's considered an emerging market or a good, strong market. So if let's say the bucket is full, but it's just floating around and it's stagnating, and we've got leakage, but we don't have too much coming in up top, and that bucket starts to shrink because that leakage is leaving the market, that is a deflating or declining economy, and that's not great. If it's just kind of hanging around, it's not overflowing, it's just kind of above that little hole of the leakage, but there's enough coming in and it's just about equal to the amount of going out, that's a stagnant market. So we can win in all of these markets depending on how you buy. But most people want to be in an emerging market or a good, strong, overflowing bucket. So do you guys kind of understand how that analogy works? We got export sector jobs, money flows into the market, fills the bucket up. There's always leakage because people spend money outside of the market. So we must have a constant flow of export sector money into a market for a market to thrive. So if Volkswagen was the only export sector employer in the market and VW left and took all the jobs with them, the faucet will shut off and the economy will eventually die because it can't sustain itself. So does anybody have any questions about basic employment?
Hi.
Hi, BB.
Yes, I know you're in the Philadelphia market. I recently went to Pennsylvania. I was there a year ago, and I noticed so many companies are relocating there and making their manufacturing place and storage. The growth there is just dramatic, as in it's so wide, different companies. So my question to you is, what do you think about that kind of growth in that area of markets? Because I heard that yes, because I heard that that area helps logistics to about 60% of the nation. So what do you think about such area? And how does the money flow in and flow out? That's what I want to understand.
So you want to find out where the money, yeah, you have to find out where the money is coming from for that employment, right? So do they have goods and services that's just targeted to the local market? So if the goods and services are targeted to the local market, that means the local people are buying that goods and services, and that money is just circulating. And that and I'm about to go into that next. But if it's an export job where goods and services are being sold throughout the nation, outside of the market, and then the money is then coming into the market by paying into the employees, then that's an export sector job, and that's good. So that's bringing in money into the market, And
Nice.
when money is coming into the market, then additional jobs can be created.
Okay. Okay. So
So
that's
you got to look,
positive.
so you kind of have to look at what those companies are.
No, they are multinational companies. We have Amazon, we have very big companies, Target, they are all there, very big facilities and all that. So, and they're more than what I counted was more than 15 different companies. Yeah.
So if you think about like a Target or retail, who are the types of people that would spend the money there, right? So the people that will go into Target to buy stuff will be people in the local market. So goods and services are being sold within the market. The people that buy it are from the local market. So that's just circulating internally, right?
No, I think what they're doing is exporting it from there, making that place their storage and exporting it to other branches. So I really don't know.
Gotcha.
Yeah.
Okay. So I mean that jobs is always good, right? So you can any news of jobs is good. And I think usually in metro areas, that's always a pretty solid place to invest. There you can always you can always do well in any kind of market. You just got to buy right. So that's the main thing.
Thank you.
All righty. All right. So next is non-basic employment, which I kind of touched into. So non-basic employment is your support sector. So these are goods and services that are sold inside the local economy, and money is spent inside that local economy and just circulates, and plus leakage. So they are very susceptible to leakage. So let's say our team member, Trevor, he owns a bakery. So he owns a local shop. He employs local people, and the local market is purchasing his goods and services. So that's local money being spent inside a local shop, which is then being paid to the maybe 6 to 10 employees, and then being spent in the local market. So that's just local economy churning in the bucket. So let's look at that again. So there's no outside money coming in this case. In fact, there's money being spent outside of the market. So there's going to be leakage here, because if he's a franchise, he might need to buy his raw materials, his ingredients from an area outside that local market. So that's why support sector, as much as we love Trevor for building a bakery and creating 6 to 10 jobs at that bakery, we don't really care about that in the economic sense, because it doesn't really matter to us. We really only care about export sector jobs. So are there any questions about non-basic employment? Okay, cool. So the real estate demand model. So this all starts with basic employment. So in any market, it always starts with basic employment. So when you hear from syndicators that they're looking for employment growth, ask them what kind of employment. They need to know about the basic employment, because it's not all employment. It's only export sector basic employment that starts the demand model. So from basic employment, that drives total employment. So the economic based multiplier causes a ripple multiplier effect when we have basic employment coming into or leaving the market, and that will affect total employment. So total employment then drives office and industrial demand, and total employment also drives total population. So we get our economic based multiplier to get total employment. Then we get the population employment ratio to get total population. And then total population drives industrial and residential demand. Total population also drives disposable income, which then drives retail. So that's the basic real estate demand model. And this is high level, but you need to understand, just understand that it all starts with basic employment. And so it all boils down to demand is people, supply is space, and jobs is economics. So let's go back and talk about KPIs. We're not going to go through all of them today. We'll just start with the past indicators. So the past indicators, we have employment trends, diversification, and competitive advantage or shift share analysis. So employment trends. So you want to look at historically, how has employment been, and compare that to the national average. So you can find that out by going to bls.gov, which is the Bureau of Labor Statistics, and get the raw data of total employment numbers. So what we want is non-farm employment, so none of the farming employment. If you're savvy enough to figure out the trends based on the raw data, hats off to you. I actually have a Excel workbook that can help me do this, that I can share with you guys if you guys want it. That will split the information out like this on this table and on this chart here. So here's an example of an employment trend analysis for Columbus, Ohio. You can see the leftmost colored column shows the U.S. change, in employment, and the right side is the market of interest employment change. So over the past 10 years, looking at that graph, it looks pretty in line with how the nation did as a whole. And the 10-year growth rate is just slightly higher, at 1.5% in Columbus compared to 1.3% nationally. There's also year-to-year data, which allows you to see on a monthly basis. The Bureau of Labor Statistics only goes, I think when I looked, we only went up to December of 2022 for US, and it wasn't available yet for Columbus. So the Metro typically lags about 2 to 3 weeks behind. So in January, we can see that Columbus did a lot worse than the US. So that's kind of interesting. But then over the next couple of months, they did about the same, and it goes up and down compared to the US. So overall, employment-wise, it seems Columbus, Ohio did just maybe slightly better than the national average. So I would say it's pretty in line with how it did. And keep in mind that this is very market specific, and it's only for MSAs, metro statistical areas. So if you're looking at a property level, it wouldn't be used at a property level. You can find out how that market is doing. And next, employment diversification. So you want to see what the different industry sectors are in your market. So these are your NAIC sectors, your North American Industry Classification. So that's like manufacturing, education, financial, insurance, trade, transportation. So sectors. So you want to see a diverse set of employment sectors, and not just one or two main sectors that take up most of the economy and have very little elsewhere. Because what happens if the main employer in the market leaves? The market collapse. So you can find this data also at the Bureau of Labor Statistics, where they'll give you the raw data of number of jobs in each industry sector by month. You can then take that total number of jobs in each sector and then plot them on a pie chart like this, to compare how much of the jobs in that market belongs to each sector. So this is the pie chart for industry sectors in Columbus, Ohio. You can see that there's quite a number of sectors, and for the most part, it's pretty even. There's no one sector that's taking up most of the jobs in that market. You compare that to Las Vegas, a handful of industries take up most of the market. You see a combination of food, administration, and retail and trade, and healthcare that take up over, I would say, over 50%, maybe 60% of the market. So it's not the most diverse market. So you kind of think of this Las Vegas as a one-trick pony. That's not to say that you should avoid Las Vegas. You can be very profitable there. I know Alex Lovely and the Legends Group, they're very focused on the Vegas market, and they're killing it out there. I think I saw a hand up earlier. Did somebody have a question? Hi, Jan.
Yes. Can you hear us, Victor?
Yeah, I can hear you guys. How are you guys doing?
Good. Jan and Anthony here in Atlanta, Georgia. I actually had a chance to sit next to Ken at a convention for 45 minutes uninterrupted. And he talked about this exactly, because I had a opportunity and a strategy with a niche strategy. And he said, you don't want sole source tenants. You want to be able to diversify a little bit. Even though he really liked what our strategy was, he cautioned against a certain percentage of being from that one industry. Like he said, he would never go into a market that's solely, say, like military base housing, because if that base is closed, you're done. So, and to your point, whether it's a military base or a single source employer, you have to be careful. The second question is, we live here in the South, so there's a lot of emerging markets, right? And being here locally, we know of opportunities that are occurring in the future, such as, where a new employer is bringing in 7,500 jobs, another complete enterprise is bringing in the next 8 to 10 years, 135,000 employees. The question is, how far out ahead of the curve or the growth or the emergence do you get when most of the investors that we hear from, from day one, they want their properties being revenue producing, right? But when an opportunity is coming, it almost leads itself to doing some development as well. I just throw that out as a hypothetical, but something that literally is happening within 10 to 15 miles of where we live.
So you want to be careful when it's, 8 to 10 years out, right? Because that's very speculative, and things can always change. Things can always throw a wrench in a plan.
That is true.
And that never happens. So,
ground is broken on the infrastructure, and being in the industry that you're in, you're familiar with RTP over in North Carolina, right?
I am not.
Okay, Research Triangle Park, all the high tech, biotech, all of I'm
in Philadelphia, so I know more in the tri-state area than the Southeast.
I was a 40-year Bristol Myers Squibb guy, so
yeah. But yeah, and in terms of buying properties, you always want to buy cash flowing properties, right? So it's really tough to buy on appreciation or buy on pro forma. I know in the past 3, 4, 5 years, the market has just been so hot. It's almost like you couldn't lose. Year after year, the interest rates have been lower and lower, historic lows after historic lows. So that's why people have been so aggressive, and they're not buying on, especially if they bought it through a broker. They weren't buying on present performance. They're buying on pro forma in what they think to buy in the future, because it's just been so competitive. You couldn't buy it at what the current performance is. So the environment is totally different now. It's time to go back to the basics, go back to the fundamentals on how to buy a property, and that's buying cash flowing properties to be safe.
okay.
So
Yep.
that should always be the plan, especially in this type of environment right now.
Yep. Thanks for grounding us again.
Yeah. All right. So next, competitive advantage. So what is competitive advantage? These are circumstances or factors that allow a local market economy to produce goods or deliver services with better quality and or pricing than the national economy. So how does this relate to your market? Well, it all relates to jobs again. So you want to use the national economy as a benchmark and compare that to your market. So we look at competitive advantage through what's known as a shift share analysis. So which allows us to identify a specific regional industry that showed faster or slower growth compared with the compared nationally over a certain period of time, and also determine how much of a regional job growth can be attributed to national trends and how much is actually due to unique regional factors. So and that unique regional factor, that's the regional shift. So a shift share analysis will help us to answer the question, why is employment growing or declining in the regional industry sector? So a shift share analysis is split, and it's split into three categories: national growth, industry mix, and regional shift. And the relationship between them is actual growth is national growth plus industry mix plus regional shift. So what does this all mean? So the idea is to use the national economy as a benchmark to compare your regional market to. So national growth explains how much of the region's industry growth is explained by the overall health of the national economy. So if the nation's economy as a whole is growing, you would expect to see some positive change in each industry in your local region. So, we've all heard the saying, a rising tide lifts all boats. The industry mix, so this represents the share of a region's industry growth explained by the growth of that industry on a national level. So if nationally the industry grew by 3%, you would expect your local region to also increase by 3%. So now the regional shift is the most important of the three indicators because it explains how much of the change in an industry is due to some unique competitive advantage that the region has because the growth cannot be explained by national trends in the industry or the economy as a whole. So let's go through an example. So say over a certain period of time, nationally, total employment grew by 4%. And now we're looking at a specific industry and in a specific market. So let's say we're looking at the employment service industry. Say that nationally it grew by 15%, and regionally it grew by 350 jobs in the local market. And there were a total of 1,000 jobs in that market at the beginning of the time period we're analyzing. So going back to that formula that so the employment services industry, they grew by 350 jobs regionally. So that's your actual growth. So we want to see how much of that is due to national economy as a whole, how much is due to the industry trend nationally, and if there's some growth that can't be explained by national trends. So national growth, so if the entire national economy grew by 4%, we would expect the regional employment services industry to also grow by 4%. So in this case, that will be 4% of 1,000 jobs. So you would expect 40 jobs. So then the industry mix, so that's the employment services industry. So nationally, it grew by 15%, but we would subtract out the 4% growth of the national economy to get the national industry specific growth of 11%. So 15% minus 4%, that gets you 11%. So you apply that to the regional industry, you would have expected employment services to grow by 110 jobs due to the industry specific trends at the national level. Now, so now we have enough information to determine our regional shift. So the employment services industry grew by 350 jobs regionally, but 40 of those jobs might have been expected due to national trends in the economy as a whole, and then 110 due to national trends in the industry. So 40 plus 110, that's 150 jobs that's expected due to national trends. Since the actual growth was 350 jobs, you subtract 150 from 350, that's 200 jobs that can't be explained by national trends. So that must be attributed to some sort of unique conditions and advantages in that region that the region possesses, which contribute to the growth of this specific industry. So that's a good thing. So that's a strong industry during that particular period of time. So if we look at a different example, so let's take that same national growth of 4%. Let's look at the apparel manufacturing industry. And let's say that it actually declined by 5% nationally and declined by 80 jobs in the local market. And there were a total of 200 jobs in the market at the beginning. So actual growth or in decline in this case, this is a decline of 80 jobs. So for national growth, you would have expected a 4% growth because the national economy grew by 4%, meaning we might have expected it to grow by 8 jobs simply because of general economic growth. Industry mix. Not only did the apparel manufacturing industry not grow the expected 4%, but it actually declined 5% nationally, meaning we would have expected a regional loss of 9% or 18 jobs due to national industry specific trends. So now for regional shift, we might have expected a net change of a negative 10 jobs regionally based on negative national trends, but in fact there was a regional change of a negative 80 jobs. So regional shift is actually negative 70 jobs, indicating that it fell short of the expected change by 70 jobs due to some specific conditions in the region. Could be something like closing a factory. So that means that industry did not do very well during that particular time. So how do you do a shift share analysis? So you can go back in time and see how the basic employment sectors that are driving local economy, how it did over a certain period of time, say during previous recessions. So this will be very, very helpful information, because we kind of know where we're going, right? We're hearing that we're going to go into a recession soon. So we can go to a website, shiftshare.stdb.com. You can pick your county and you can define your time period, and it can spit that shift share analysis back to you so that you don't have to do this calculation. For those that you don't know, STDB, it's Site to Do Business. It's a website for commercial real estate professionals that provides tools for financial, market, and competitive analysis, which includes shift share. CCIM members, which is the Certified Commercial Investment Member, and that's like the MBA for commercial real estate. They all have access to Site to Do Business. Other functions are paid access, but lucky for us, shift share is open for public access. So I use this tool to go look at different recessionary periods in the past and how that market reacted to those recessions. Did it grow? Did it shrink? Was it stable? And I'm looking for trends. So if we look back in history, we had recessions from 1990 to 1999. That was the Gulf War recession. We had another one from 1999 to 2003. That was the dot-com recession. And then another recession from 2007 to 2010, which was the Great Depression or Great Recession. So I would look at these recessionary periods and see how the market reacted to the recessions to see if it grew, shrunk, or was stable. So just remember, past performance does not predict future results, but we can look at trends. So if historically a market fared well over each recessionary periods, and I had a choice in where to buy, I would rather buy in a market that grew or was stable during past several recessions. So this shift share site goes from 1990 up to 2018. So we don't have information about the COVID-19 mini recession in 2019 and 2020. But we can see how it did in previous years. So so this is what the website looks like. And then if you go further down, this is what it shows. It shows you the industry sectors. So the sectors that are highlighted in green, those are your basic employment sectors, and those are the employment sectors that we want to look at. So we can go through time and take a look at the column regional shift, which is the column that we're really interested in. Again, that tells you what the change in employment is that can't be explained by national growth and industry mix. So this example here, we're looking at Franklin County, Ohio, which is where Columbus, Ohio is. And we're looking at 2008 to 2010, so which was the Great Recession. So if we take a look at transportation and warehouse sector here, from 2008 to 2010, employment dropped from 44,000 to 37,000. So they lost about 7,000 jobs. Based on the U.S., how the U.S. did as a whole during that time, which is the national growth, it was expected to have lost 2,476 jobs. And then based on the industry, how the industry did as a whole during that time, which is the industry mix, it was expected to have lost 1,281 jobs. So based on the national growth and industry mix, it was expected to have a loss of 3,757 jobs, but there was actually a loss of 7,209 jobs. So there were a total of 3,452 jobs lost that couldn't be explained by national growth and industry mix, which is the regional shift, meaning the industry didn't fare very well during the Great Recession. This particular sector didn't do very well. Again, regional shift is what I really care about, and it shows how the sector did. So if it was positive, I would consider that sector grew. If it was negative, I would consider that it shrunk. So let's take a look at another one. So let's take a look at finance and insurance. So during that time frame, they lost about 1,500 jobs. Based on national growth, it was expected to have lost 2,600 jobs. Based on the industry mix, it was expected to have lost 500 jobs. So it was expected to have lost 3,100, about 3,100 jobs. And if you look at the results of the regional shift, you can have a picture of how the market reacted to the recession. So here they actually grew by 1,644 jobs that could not be explained. So I think that particular sector did well. So if you look at it all, so for Columbus, Ohio, during the Great Recession period, add all these regional shifts up, there was a total of 872 job loss in regional shift. So in the great scheme of things, if you look at the total employment numbers, that's a pretty small number compared to the total number of jobs. So for the most part, I would consider it a pretty stable market during the Great Recession. So what you want to do is you want to do this for the .com recession and the Gulf War recession, and you can see if there's a trend of being stable in that market. So if they are stable in each of the recessionary periods, or if it grew during the recessionary periods, I would say that that's a pretty good market. Whew. So we made it through what we wanted to cover this week. So homework for next session. If you didn't do this, the homework for last session, here's your chance to catch up. So I want you to pick your market, research what new jobs are coming to that market, identify whether those jobs are considered export sector or support sector, meaning are they basic jobs or are they non-basic jobs? You want to research how diverse the employment industries are in that market. You can go through that by using the website here and the spreadsheet that I can share with you guys. And then you guys can also research how the market reacted to previous recessionary periods through the shiftshare.stdb.com. So I can open it up to any questions that you guys had. I mean, this is a doozy. I know that you probably don't hear many gurus, any groups talk about this. So I think that this is pretty important to know about.
Hey, Victor, how you doing?
Hey, how are you doing?
I'm good. Can you share that last page one more time so I can screen grab it?
Oh, okay. The homework?
Yes, the homework. Thank you.
Yeah.
Got it. Thank you, Victor.
Cool. I see Yana.
Hi, good night. It's Ayana.
Oh, sorry.
No, it's fine. It's fine. My Gmail has a different name. But just a question: what is the recommended mix for basic and non-basic type of jobs?
So there's no like guideline for that. You want to look at overall. So if you go to the first, let me find that site again. So if you go to the Bureau of Labor Statistics and here, there's a here down here, you can find, and if you can reproduce this graph, this give you a pretty good idea of how the breakup of the industry sectors are. And from there you can kind of figure out, is it diverse or is it not diverse? And then you would want to know, then you would have to actually go into the market and see who are the employers in the market. And from there you can figure out whether are they a lot of export sector jobs or non-export sector jobs. So does that answer your question? So there's no kind of guideline. You have to know who are the major employers, who are the major employers in that market.
Okay, so the diversification would kind of mitigate any concerns with whether it's basic or non-basic.
Well, it gives you of a how diverse that market is. And the more diverse it is, the more I guess the safer it is. But again, every market is different. Obviously certain markets are stronger in certain sectors because maybe certain employers are gathered in that particular area. The Southeast, Atlanta, Southeast Tennessee, Georgia, Alabama area. It's a really big automotive hub now. It's like the new Detroit. So they have a lot of car manufacturing over there. So that's a really big export sector job, and they're very economy friendly. So they're very business friendly over there. So I think that's a big reason why a lot of people are flooding down to the Southeast, investing over there. So the answer to your question is you have to research your market to find out who are the big employers.
Okay, thank you.
Cool. And Dan, yes, this recording will be available. We'll be posting it to our YouTube. Let me share all of our information again. If you guys are not part of our Facebook group, please join our Facebook group. And if you guys can like and subscribe to our YouTube, you guys will get notifications of all of our replays, for all of our Zooms, all of our community Zooms. I'll probably share the worksheet for the employment trends on our Facebook group. So I think that would be the easiest way to share that. Cool. So just a preview again. If you guys, we have the Waldorfs coming on our activation Zoom on Sunday. They're a big group in the Chattanooga, Tennessee area. I think Marcel has a pretty good relationship with them, and they will be a really good people to listen to. I think that's we'll be really interested to hear what they have to say. All right. So if there's,
Victor?
hey, is this Cheryl?
Yes. Hello.
How you doing?
All right. You?
Good.
Good evening. Oh, getting tired. You already know. I'm probably preaching to the choir. I had a question. If I know my market generally and it's more than one, how do you want to have the homework?
So this homework is more for you to take actions. And then when we go on to the next session, what we discuss what your homework will flow into what the next session's topic will be. And so it's designed to be like a step-by-step for us to all go along the way.
Oh, okay, good. Great. And I think we'll develop a lot of great collaboration with that. So I appreciate that.
Mm-hmm. So, I mean, we always like to leave everybody with some actionable steps, because if everybody just hops on a Zoom, just consume and don't have any action steps, then it's just listening for fun, right?
Facts. Very, very good point.